David, the OBR, or the Office of Budget Responsibility, projects that the UK's debt to GDP ratio will rise to 95%. Is this a concern?
Not in short, I don't think it is. It's often said that the debt to GDP ratio that we're going to have will be the highest since World War II. And that's true, but it's nowhere near World War II levels. Back then, it got to around 250%. The key here, though, is affordability. Interest rates are much lower now than they were there. So, for example, last week, the DMO raised 40-year cash at 0.6%. The average since April has been less than 0.5%. And in fact, last week, the DMO did its first ever issuance on a negative yield. So affordability being key, this looks very affordable. It's worth saying as well that the 400 billion plus of existing QE stock that was there before this latest round of QE is now being financed at 0.1%. That's down from 0.75%. So what we'll find actually is that this year, the government is almost certain to spend less servicing its debt than it did last year. In terms of international comparisons, if we were still in the EU, 95% would put us around the middle of the pack. So it's no great drama to be at 95% on an international comparison. The government will be able to afford this. The only concern will be if we see borrowing at these kinds of elevated levels year after year, and that seems highly unlikely.
What are your expectations regarding an extension to the Bank of England's QE programme?
Well, our house forecast is for the Bank of England to do an extra 200 billion QE and for that to be announced in June. I think the key here is that we're still relatively early in the response to this crisis, and the bank won't want to see a rise in term interest rates. That would represent a tightening in financial conditions, and that's exactly the opposite of what the economy needs at the moment. At the onset of the global financial crisis, the Bank of England did 200 billion QE in the first year, and it also did 450 billion of rate cuts. This time around, we've had 200 billion QE announced already, but only 65 basis points of rate cuts. Our house forecast is for GDP to contract this year by almost twice as much as the contraction we saw in 2009. So it's hard to see the Bank of England wanting to do less now than it did then. Even as the lockdown eases, the economy is going to need a lot of help to get back on its feet. Something like 40% of the workforce is either claiming unemployment benefits or furloughed. And so the economy will need some real help getting going again. So far, the bank has acted decisively and aggressively to support the economy, and we'd expect that to continue.